All right, let's jump right into this because today we've got a real puzzle on our hands. It's one of those fascinating head scratchers from the world of finance that seems to break all the rules of logic. And it's all about China's currency, the yuan.
So get this. On the one hand, China is selling a ton more stuff to the world than it's buying from it. We're talking about a massive trade surplus, which means a flood of foreign money is pouring into China. Now, textbook Economics 101 says that should make their currency way stronger, right? But nope. The exact opposite is happening. The yuan has actually been getting weaker, especially against the US dollar.
So the big question is, what gives? I mean, how can a country with that kind of positive trade balance see its currency fall? It feels like a total contradiction. But it's actually a perfect reminder that real-world economics is, well, it's a lot messier than what you read in a book. So let's play detective and break down the clues.
Okay, clue number 1. This one is all about control, specifically who's in the driver's seat. See, unlike a lot of major currencies, the yuan's value isn't just left up to the whims of the open market.
China uses something called a managed exchange rate. And honestly, the best way to think about it is like a thermostat for their currency. Instead of just letting the temperature float around, the central bank, that's the People's Bank of China, or PBOC, they set a very specific range and then actively step in to keep the value right there. This is a huge difference from a free-floating currency like the US dollar, which is pretty much at the mercy of supply and demand.
And here's how they do it, mechanically. Every single morning, the PBOC sets what's called a reference rate. Think of it as the official starting price for the day. Then, for the rest of that day, the yuan is only allowed to move within this tiny little window, a very narrow band just above or below that official number. So you see, no matter how fantastic the trade data is, at the end of the day, Beijing holds the leash.
Let's move on to our second clue. This is all about the flow of money, what China is actually doing with all those US dollars pouring in. And the really interesting part here is that their whole strategy has changed.
See, back in the day, China would take those incoming dollars and basically just vacuum them up into its gigantic pile of foreign reserves. But to do that, to buy all those US dollars, they had to sell their own currency, the yuan. That created this huge, constant demand for the yuan that helped keep its value high. But now, they've pretty much stopped doing that. They're not hoarding every dollar that comes in the door anymore.
And the consequence of that shift is really straightforward. Since the government isn't constantly buying up dollars anymore, one of the key artificial forces that was propping up the yuan's value is, well, it's gone. It's like they've taken their foot off the gas pedal.
All right, for our third clue, we need to zoom out and look at the bigger picture, because this isn't a story that's happening in a vacuum. To really get why the yuan is doing what it's doing, you have to look at its main dance partner.
And I'm talking, of course, about the US dollar. You know, a currency's value is always relative, and right now, the dollar has been on an absolute tear. It's been incredibly strong, partly because of higher interest rates in the US, but also because it's seen as a safe haven asset. Whenever things get rocky around the world, investors park their cash in the dollar.
You can really see the effect of that here. It's kind of like having one really tall person in a group photo. They make everyone else look shorter by comparison. That's what the dollar is doing. It's flexing so hard that pretty much every other currency out there, including the yuan, looks weak next to it.
Okay, on to our fourth and final clue. And this one's a little less about hard numbers and more about a feeling. It's about psychology, sentiment, and the all-important confidence of global investors.
You see, despite all those exports, China's domestic economy is facing some serious headwinds. Investors are looking at the ongoing troubles in the huge real estate sector. They're seeing that Chinese consumers just aren't spending like they used to. And they're hearing these scary whispers about deflation. That's when prices actually start to fall, which is a really bad sign for an economy. So you add all those worries up, and what you get is nervousness. When the outlook for China's growth seems weaker, international investors start to get hesitant. They're not so eager to put their money into yuan-based assets. And that lack of confidence, that lack of demand, puts direct downward pressure on the currency.
So there you have it, our 4 clues. The government's control, the shifting flow of money, the strong dollar, and the confidence game. Now let's put all the pieces together and solve this paradox.
Here's the bottom line. The yuan is stuck in a massive tug-of-war. That huge trade surplus is on one side, trying to pull the value up, but you have all these other powerful forces pulling in the opposite direction. You have Beijing's own controls, the changing capital flows, a super strong US dollar, and worries about the domestic economy. Right now, the forces pulling it down are simply winning.
And that really gets to the core of it. There's no simple formula. I love how one of the sources for this put it. Economics is a messy, multi-factor beast. You simply cannot look at one number, no matter how big and impressive, and think you understand the whole story.
And that is the big takeaway here. That enormous trade surplus, it's an important piece of the puzzle for sure, but it is just one piece. The value of a currency is a complex mix of government policy, global events, and good old-fashioned human sentiment.
Which leaves us with a final thought to chew on. If a massive trade surplus doesn't automatically make a currency stronger, it really makes you ask a deeper question. What does a strong currency even mean in today's world? And is it always a good thing? Or could it be that, for a country that relies on exports, a slightly weaker currency is actually exactly what it needs?